So the next topic we have is the statement of cash flows. I'm sure all of you are professional accountants and some of you are planning to become one. Statement of cash flows classifies cash flows into three categories. Cash flow from operating activities, cash flow from investing activities, we'll discuss all these in detail, and cash flow from financing activities. What are the sources? Operating cash flows come from your income statement, your operating inflows, selling goods and services, and your operating outflows, different types of expenses. Investing activities, as clearly shows investment made in long-lived assets or non-current assets, investments in securities. So when you purchase or sell any security, when you purchase or sell any asset, it is considered as a part of investing activities. And finally, the third section, we're going to discuss all these in detail, is called the financing section or the financing activities. These activities involve issuing shares or redeeming shares. This section involves issuing bonds, debentures, taking bank loans, or repaying bank loans. So all the inflows, outflows related to shares, all inflows, outflows related to bonds, loans, debentures come in financing section. We'll discuss this in detail. So these are the three sections of your statement of cash flows. We will learn how each component is presented, what are the components of each category of cash flows. But let us first discuss what FASB says. FASB is the US accounting body that regulates accounting standard. FASB prescribes, just like we have IASB, International Accounting Standard Board. So in the US, they have FASB, Federal Accounting Standard Board. So we issue IFRS, IASB issues IFRS, FASB issues US GAAP, Generally Accepted Accounting Principles. So they prescribe two approaches. Please remember, there are three sections of your cash flows: operating activities, investing, and financing. FASB says that operating activities can be prepared in two ways. One is the direct method, I will explain, and other is the indirect method. What is the difference? I will show you with the actual format. So FASB prefers the direct method. There are two ways of preparing your operating cash flows. I'm not talking about financing and investing. Operating cash flows can be reported in two ways, either direct method or the indirect method. In direct method, you simply gross up all your cash receipts from customers, cash received against cash sales, any interest received, income received on deposits, dividend received, and the cash payments or disbursement for salaries, for wages, for rent, for insurance, so on. Just like normal cash receipts and cash payments related to your operating activities. FASB prefers the direct method because it's quite sensible. Let me show you how the direct method looks like. This is it. This is the direct method where you have the cash receipts from your customers, cash received by selling trading securities. We will discuss this in our subsequent classes. What are trading securities? Any interest earned, any dividend received, or any other cash flow. These are all operating cash inflows. And then all the operating cash outflows: payment for inventories, purchase of securities, salaries paid, interest paid, taxes paid, or any other operating expenses paid. So let's say if you get a total of, let's say some assumed numbers, I'm not talking some specific numbers. So let's say I have 1.5 million as my inflows, all of these total, and I have 700,000 as my outflow. Just assume numbers. So my net cash from operating activities is $800,000. This is by using the direct method. There is also another method. Faizar, when you have made investment in some other company's shares, so as an investor, you will receive dividend as a return on your investment. You do not receive dividend on your own company share. You have invested in some other company's shares, and that share capital or that investment in shares results in some dividend payments. Ji Hashir, please ask.
Sir, can we consider the cash receivable which we will receive in 10 days or 15 days?
Yes, yes.
So can we consider that cash inflow here or not?
Yes, your operating cash inflow.
We will consider it as inflow.
Yes, inflow
Yeah.
from operating activities.
Whichever cash we will, yeah. I am not talking about the cash which we have. I am talking about the cash which we will get in 15 days or
Absolutely.
13 days
Yes,
period.
yes, that's
That
the
we will include.
exactly. That's the inflow. Exactly. So this is what you call the direct method, where you take gross cash receipts and disbursement. There's another method called the indirect method. In this method, what we do, we begin with the gap-based net income and we make some adjustment into it. What kind of adjustments? Let me show you. Straight to that slide. This is it. This is the indirect method. In indirect method, what we have, we start from your net income, right? I'm taking some assumed numbers, so please do not get confused. Let's say my net income for the current year is 2.5 million. I make some adjustments. I will explain these adjustments later. These adjustments give me a positive 730, assumed number. And a total outflow subtractions are 1930, let's say. Again, deducting these, this plus this, less this gives you exact same number. So the point is, whether you are using the indirect method or whether you are using the direct method, your cash provided by the operating activities is the same, right? So we'll discuss these in later detail, but let us first have an overview what FASB says. So FASB says that ideally you should use direct method. An indirect method is an allowed alternative. FASB expresses preference for the direct method. But the problem is, if you use the direct method, you will also have to provide the reconciliation of your operating income to the cash generated by operating activities, which basically is the indirect method. Let me explain this concept, a little fine idea. If you are using the direct method, you have calculated cash flow from direct method, you are required to reconcile your net profit to the cash flow from operating activities, which basically is your indirect method. So that means if someone asks question, IFRS, again, IFRS also prefers direct method and it also allows indirect method. Preference to direct method is given both by FASB as well as IASB. IFRS also, IS 7 cash flow, it also prefers direct method. But, and again, it requires that you need to, if you are following direct method, you have to reconcile your net profit with cash flow from operating activities, which basically is the indirect method. So the conclusion is, if you are following direct method, you have to follow the indirect method also, both in a single go. So for this very reason, firms mostly simply employ the indirect method and they simply avoid the direct method. Yes, Salman. So that is the reason in my professional accountancy career, I have always used the indirect method. Wherever I went, this is the method used, right? Because direct method is more hassle. So let us discuss some in detail the different sections and what do we see in these different sections of cash flow. Cash flow from operating activities, investing and financing. Let us see one by one. Your operating cash flows means the money you receive from your customers, money you received as an interest on your deposits, dividends received, just like Heather, you asked a little while ago, dividend received, you have invested in some company and you receive some return on your investment and you sell any trading securities. They are all operating inflows. What about the outflows? Indirect method is more convenient, easier, best. Payment to employees and suppliers outflow, expenses, rent, insurance outflow. If you purchase trading securities outflow, interest paid, taxes paid, clearly they are operating outflows. Then the next categories are investing activities, cash flow from investing activities. You buy a fixed assets, it's an outflow. When you sell a fixed asset, it's an inflow. When you sell debt or equity securities, it's an inflow. When you acquire any debt or equity, debt means any bond you buy or any shares you buy, it's an outflow, right? Similarly, principal received from loan made to others. If you give loan to someone, some other companies, maybe your subsidiaries, you receive your loan back, the loan that you gave to your subsidiary. So principal received from, I hope you know, principal is the base amount of the loan other than the interest. So principal received from loan is an inflow and loan made to other is an outflow. G, please ask. Hashif.
So this sale of debt means that we are giving some loan to others. Is it like this?
No. Sale of, you have purchased bonds. So when you acquire bonds or when you acquire shares of some other company, it's an outflow. But when you sell those bonds And when you sell those shares, you get money, right? Bonds and shares of other companies.
Sale of debt is also similar to that, like we are investing in some other companies.
Bond, no, the more appropriate. Actually, I've taken these from my CFA slides. So here I should have written bonds or debentures, more appropriate. So when you buy bonds or shares of other companies, it's an outflow. Or when you sell those bonds and equities, it's an inflow, right? And when you give loan to someone, loan to others, and some subsidies, it's an outflow. And when you receive your loan back, the principal part, it's an inflow, right? So these are the cash flow from investing activity. The third part is the cash flow from financing activities. Financing activity means when you issue shares, issuing bonds, it will inflow. See, proceeds from issuance of stock. When you issue shares, preferred stock or the common stock, it's an inflow. When you issue bonds, debentures, that's an inflow, right? Or you take loan from the bank. And when you repay the debt or you repay the leases, it's an outflow. When you acquire your own stock from the market, the treasury stock, purchasing your own stock, it's an outflow. Dividends paid to shareholders. Remember, dividends in the US GAAP, the dividend paid to your shareholder, it is considered as an outflow, as a financing outflow. This is a marked difference between IFRS and US GAAP. And this is something you don't need to know specifically. This is the part you need to know, just this part only. That is relevant to your CMA. This is basically some part extracted from my CFA slides. So let me show you how these different items are treated under the US GAAP and IFRS. If you receive interest on your deposit with a banker, that interest received is considered as an operating inflow under US GAAP. IFRS says you can treat it as an operating or an investment cash flows because you receive interest on your deposits with the banker. So it's an investing inflow. When you receive dividends, you have made investment in some other companies. That dividend is considered as an operating inflow. Under IFRS, it is either operating or investing, just like the interest. So when you pay interest, you have issued bonds or debentures, or you have taken loan from the bank, you are paying interest. This interest payment under the US GAAP, it is considered as an operating outflow, but under the IFRS, you may treat it as a financing outflow for the loan you have taken, or you may consider it as an operating outflow. This is the most important way you people will be tested. There are many questions on this. When you pay dividends, US GAAP specifically requires you to write it as a financing outflow. Clearly, no other option allowed. But under the IFRS, dividend paid to our own shareholders, it can be reported either as a financing or as an operating outflow. This is what you are most concerned with as CMA students. Under the US GAAP, you will find the dividend payment as a financing outflow, and interest paid is treated as an operating. In both cases, there are some fine details to which we are not interested. So now let us do the actual direct method we have already considered. Let us see how do we do the indirect method. Try to make sure you understand it fully, so when you will be doing it tomorrow with actual computational questions, you will be able to understand them well. Let us discuss these one by one. Now, let's say my net income as per the US GAAP from my income statement is 2.5 million. And I am using the indirect method. Preferably, indirect method is used by the companies because you simply need to use indirect method and all the related parts to operating cash, investing cash and financing cash flows. But if you follow the direct method, for direct method, you also have to follow the indirect method also. You have to prepare the statement also. This is the reason why we simply use indirect method. So your operating income, or I would say the net income under the US GAAP is 2.5 million. Let us see why these items are added or deducted. Please make sure you fully understand each element. Indirect, Rajesh, you will be tested on indirect method. That you will find hardly a single or a couple of questions on direct method, which are very straightforward. You would be tested on in the indirect method, historically. Now listen to me. What you're going to add, what you're going to deduct, and why. First thing you will see is your receivables. If your receivables have decreased over the period, like your opening receivables were 100 at the start of the year, at the end of the year, the closing receivables are 80. So whenever your receivables decrease over the period, that would mean that they have paid us. So decrease in receivables, if your account receivable balance falls, that means they have paid you. So decrease in receivable is added. To the contrary, if your receivables have gone up over the period, 100 was the opening, not 180, they did not pay you. They did not pay you. So when they don't pay you, it's effectively an outflow. So increase in receivable is an outflow, right? Decrease in inflow. Same thing goes for inventory. If your inventories have decreased over the period, they would have released cash into your business. Reduction in inventory is good. Inventory is leaving the business, and that means that it will bring in cash flow. So decrease in inventory over the period is an inflow, whereas increase in inventory is an outflow. Fine. What about payables? I had $50 payable at the start of the year, and at the end of the year, I have $90 payable. Now, that is good. I have held on to the payments. I didn't pay my suppliers. That is good. If your account payable goes up, that means you have withheld the payment, you have slowed down the payment, resultantly, it's an inflow. Increase in payable is good for the business, reflected as an inflow. And to the contrary, if your payables have decreased over the period, like if it was 500 and it has fallen to 390, so decrease in payables means you have paid to your suppliers and it's an outflow. That is, we do it all the time, not just at the end of the year. We just hold on to the payment to our suppliers so that we can have good cash flows. Exactly. You're absolutely right. This is the common problem with every business, that we need to hold on to the payment to our suppliers so we can manage our own cash problems. Okay, guys, so that makes sense. Now, let us go to some technical areas now. Now, listen to me very, very, very carefully. This is your net income under the US GAAP, 2.5 million, okay? When I calculated this income, I deducted depreciation as an expense. Of course, it's an expense charge against the revenues. But the question is, did I pay any cash for depreciation? Of course not. Depreciation is a non-cash expense. I have deducted an expense from my sales, from my gross profit, for which I paid no cash. Since it's a non-cash transaction, it did not result in any outflow. I should reverse depreciation charge. I will add back depreciation because it's a non-cash expense. Yes, depreciation to be added to the net income. Absolutely right. Similarly, when I issued bonds, there is a discount on bonds. This amortization of bond discount is not a part of your syllabus. We'll discuss this briefly maybe in the coming classes. So this is again a non-cash expense against your income. It is added back. Remember, amortization of bond discount is a non-cash charge against your income. Like depreciation, it is added back. Similarly, the amortization on bond premium, it's a non-cash income, which is included in your income statement, so it needs to be removed. So bond discount is added and bond premium amortization subtracted. So this is it's an advanced topic, so I won't like to discuss it here, maybe later on. So just keep it in mind, this is non-cash expense to be added and non-cash income must be deducted. Now, in the same way, during the period you might have sold some plant or some machinery or some vehicles. So let's say if we had a piece of machinery with a book value of $10,000 and you sell it for $3,000. Clearly, there is a loss on disposal of $7,000. This loss is deducted from your income. It's a charge against your income. The question is, did you pay this loss? It's a non-cash charge. Just like depreciation is a non-cash charge, loss on disposal is also a non-cash charge. So this loss on disposal must also be reversed. Loss on disposal, depreciation, amortization, and bond discount, they are all non-cash, so they must be added back. Similarly, just like if there can be a gain on loss on disposal, there can be a gain on disposal also. So this gain on disposal is deducted. So things move in the opposite order. You have to memorize this format. The slides are in the group. Please make sure you understand these components well. Similarly, if you have made an investment in some company and there is a loss, and that loss is included in this net income, but this loss you did not pay in cash. So that loss is reversed. Loss on investment in equity-based method. We will discuss this in our subsequent classes. So equity-based investment loss is not a cash loss, so it must be added back. Similarly, the same token, income from investment in equity method, if you have considered any non-cash income in your income statement, it must be removed. So non-cash losses must be added back, and non-cash income must be removed so as to we want to bring this 2.5 million accrual based net income into the cash form. So we need to reverse all the non-cash gains, non-cash losses, just I've discussed. So this would make 800,000 as your cash flow from operating activities, which is exactly the same that you will get by following the direct method. Since I've told you that indirect method is preferably used in the practical world as well as in your CM exam, so need to focus entirely on this. So please make sure you understand the format well. We will discuss this in detail in our coming tomorrow. Maybe we'll discuss a lot of questions, inshallah.
Sir, I have a question here. That is actually a very basic question. What is the difference between the depreciation and amortization?
Yes, depreciation is charged against tangible assets like property, plant, equipment, vehicles, machinery. So depreciation is charged against the tangible assets which you can touch. Amortization is a charge, is like a depreciation. It is on intangible assets like patents, copyrights, licenses, trademarks. So this is a part of your syllabus. We will discuss amortization separately in a topic. So it's on intangible property and it's on tangible.
Yeah.
So Ahmad, welcome, Harshad. Ahmad, yes, you are right. IFRS and US GAAP, they both prefer direct method, but direct method is a hassle. Too much mushkila. We want easier things for ourselves, because if you follow the direct method, you will also have to prepare a reconciliation statement, which is the indirect method. Interesting. If you follow direct method, IFRS and US GAAP says you have to create, you have to draw a reconciliation, and this reconciliation is indirect method. So that means you have to follow these two. So make yourself, comfortable. Do the simple things. See, this is the reconciliation. This is what you call reconciliation of your net income to the cash generated from operating activities. This is the indirect method. So this is the reason why in 100% cases in my professional life, I have seen just the indirect method. Exactly, Gauss, you are absolutely right. Because finding each cash flow separately is very difficult under direct method. So that's why this is more convenient. You just need your trial balance, your previous balance sheet and the current balance sheet, and you can simply do it on the Excel sheet. Whereas for the direct method, you have to search each category of cash flow. That's more time consuming and difficult. Now, the second category, investing activities, cash flow from investing activities. When you say investing activity, that means investment in long-lived assets. When you purchase land, outflow. Of course, cash goes out. When you purchase building, negative, outflow. When you sell your equipment, inflow. When you purchase available for sale securities, we will discuss this in the coming classes. All these areas will fill up when you move on to unit 2 and 3. So just here you're just discussing the brief. Purchase of available for sale securities and outflow. When you sell the held to maturity securities, they're also coming. There are three types of securities: trading securities, available for sale securities, and the held to maturity. They are in your syllabus. We are going to discuss. So remember, the trading securities, they are part of your, this is when you buy the trading securities or sell trading securities, they are part of your operating cash flows, right? But when you buy and sell the available for sale or held to maturity securities, they are considered as a part of investing. We are going to discuss in detail. And then finally, proceeds from notes receivables. You might have sold some notes which you held as an investment. So selling those notes, selling some bonds, selling some long-term investments, so they will bring in the cash inflow. So let's say the whole of it, all transactions of inflows and outflows gives you a total of 300,000. So what we have so far, this is it. We have $800,000 as our cash flow from operating activities. We have 300,000 negative as a cash outflow from investing activities. The last section is the financing activities. As you know, we have discussed it earlier. Financing activities involve when you buy or sell shares, your own stock. When you issue stock, you receive a lot of money, including your additional contributed capital. When you redeem your stock, redeemable preferred stock, it's a financing outflow. When you issue bonds, it's an inflow. But when you retire bonds, it's an outflow, right? When you take a bank loan, it's a financing inflow. When you repay the bank loan, it's a financing outflow. And similarly, this is very important. Payments of dividends under the US GAAP, it is considered as a financing outflow. Do not make this mistake. So netting of all these transactions, let's say for the sake of understanding, is a positive $500,000. Now we have three types of cash flows: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activity. Respectively, 800,000 from operating, 300,000 from investing, and lastly 500,000 from financing. So if you net this all up, you get a total cash generated by all these activities as $1 million. Now, how do you check whether you have done the right work or not while you're working in your company? You will write this 1 million here. This is what you have calculated as cash flow from financing, investing, and operating. You add your total of all the cash balances at the start of the period. This is the total cash generated by operating, financing, and investing. And let's say if your opening cash balance of bank A, bank B, bank C, bank D, some of them had negative balance, some of them had plus. Total of the balances at the start of the period was $200,000. So this is the cash generated by these three activities. 200,000 was the opening balance. The ending balance of all the banks must be 1.2 million. If you do not get this answer, and if the total of your banks at the end of the period, 31st December, if it is not 1.2 million, Ross, you have made a mistake. This is what I used to make. My total of opening balance plus the cash generated by all activities must be equal to the total of the bank balances at the end of the period. If the balance doesn't agree, you have made a mistake. Go back. You might have made some error somewhere. Yes, tax. When you take net income, Ross, when you take the accrual-based net income, this net income is already adjusted for tax. So it's basically after tax. So tax is already accounted for. Right, gentlemen? So finally, the last segment of your statement of cash flows tells you something important. Yes, exactly. So here we go.
Net profit, no, sir. Net profit to the cash balances, that's why we call it.
Yes, net profit to cash balance. Final section of your cash flow statement consists of some transactions which do not involve any cash flow, but they affect the elements of assets and liabilities on your balance sheet. Final section will contain some transactions which have no cash effect, no effect on the cash flow statement, but they affect the balances on assets and liabilities. Such transactions, such events are called the non-cash transactions. So we cannot show them within the body of the cash flow statement. Then where do we show them? What kind of transactions are non-cash? Like conversion of debt into equity. When you do this, what happens? Your debt goes down, your equity goes up. Clearly, the balance sheet's numbers have changed, but there is no cash flow. Similarly, assets obtained by assuming liabilities. You acquired an asset by taking a loan or by lease agreement. Again, assets go up, liability go up, but there is no cash. Capital assets received as a gift. Someone donated you a plant, someone donated you a couple of cars. No cash goes, but there is a change in assets. So when such transaction, or maybe exchange of non-cash assets with liability or another asset, so when such transactions take place, they definitely affect our balance sheet items on assets and liabilities and equity, but they cannot be reported within the body. They cannot be incorporated in the body of cash flow statement. How do we report them? We report them in a separate section as a summary of non-cash investing and financing activities. What has happened over the period under any of these categories will report in the writing like this. During the period, we converted 500,000 bonds into 2 million shares for par $1 only. This is a non-cash transaction. It affects your liability, it affects your equity, but it cannot be reported within cash flow statement. So we are reporting just at the foot of your cash flow statement. Next, obtained equipment in exchange of 60,000 notes payable. You got an equipment and you issued a note. So there is no involvement of cash, but your assets have gone up and your liabilities have gone up also. So you need to report it this way in the summary of non-cash investing activities, financing activities, immediately after the cash flow statements. So that completes your statement of cash flows overview in detail. We are going to do lots of questions, lots of cash flow questions, because this is the area you are most likely to be tested on your exam. Right? Hasib has a question. This is a good question, Hasib. You have asked a very pertinent question. Gentlemen, listen to me very carefully. Bad debt is a non-cash expense. There is no doubt, just like depreciation. Right? Now, why don't we treat bad debt separately? It is because bad debt is already incorporated in decrease in receivables or increase in receivables over the period. So the bad debt is incorporated within the changing in balances of your account receivable, right? So for this, we don't have a separate treatment. Otherwise, keep it in mind, whenever there is a non-cash expense like depreciation, like loss on disposal or amortization of bond discount, this is to be added back, right? So guys, that completes your statement of cash flows.